Investors and distributors are requested to note that the objective of this meeting is to communicate with our distributors and to share with them our thought process. It should be noted that views expressed in the recorded call are based on the information available in the public domain. Views expressed in the call can change depending upon changes in circumstances. Nothing discussed in the call shall constitute a buy, sell, or hold recommendation. Hi, good afternoon, everyone. Welcome to today's conference call organized by PPFAS Mutual Fund. Thank you for taking the time to join us. Today, we will discuss our hybrid and cash management funds, Parag Parekh Conservative Hybrid Fund, Parag Parekh Dynamic Asset Allocation Fund, Parag Parekh Liquid Fund, and Parag Parekh Arbitrage Fund. We are joined by our investment team, represented by our debt CIO, Tejas Soman, and fund managers Rukun Tarachandani, Mansi Karya, and Aishwarya Shashidhar. They will share valuable insights on how these funds are managed, the investment philosophy behind them, and their approach to navigating the current market landscape. We have received few questions from you in advance, and we clubbed the common ones. But first, over to Tejas for a short presentation and opening remarks.
Good evening, and thank you for the introduction. We've made a small presentation. Most of you are aware about it. Most of you know what it is. But still, we thought it can be a good refresher in terms of what we do, what we have, and what our philosophy is in terms of managing the funds. So you all are aware, we have fairly simple scheme structures. We've got three buckets. One is equity, where we have three schemes. One is cash management, where we have two schemes, liquid fund and arbitrage fund. And we have hybrid schemes, which are focused on debt funds. So today we will discuss about cash management product, which is arbitrage and liquid, and hybrid, conservative hybrid and dynamic asset allocation. About equity schemes, we've already had a call on 22nd of June. Most of the things were discussed there. Today we will cover these four schemes and the investment style, the portfolio construction, and how we manage. To start off, obviously, liquid fund and arbitrage fund are the cash management products we have. I'll just give you a brief structure and important points about liquid funds. Most of you are aware, but you would have seen this chart in our presentation on our website or in our fact sheet. But let me give you how you can read this information. So in liquid fund, the maturity usually is anywhere between 30 days to 70 days. This is as on 30th May. So on that day, our maturity of the scheme was 40 days. The YTM was close to 641. Most of the asset allocation is in CD and CP. It's our internal guidelines that we invest only in AAA assets. The AAA assets, in the sense, the long-term rating of those securities have to be AAA. We do not invest anything which is not AAA rated. We've got a lot of questions about it, whether we take credit risk, whether we go below AAA or not. The answer is no. We strictly stick to AAA assets only. One advantage of liquid fund which we have is from retail point of view, we have insta redemption facility where you can withdraw up to 50,000 or 90% of your latest holding for that day, and the redemption amount comes within 30 minutes of the redemption time. So that's one facility which we provide is there. Most of the investor existing or the institution investor look at this scheme as an interim cash parking tool to substitute your savings or your idle cash in bank account. The second is arbitrage. Rukun takes care of arbitrage. This is arbitrage yields are usually in range of 6 to 7% depending upon the spread we get in arbitrage opportunity. So we have to invest minimum 65% in our equity and equity related arbitrage opportunities. The asset allocation keeps changing between 65 to 70%. Remaining is invested in AAA rated companies. Now with the latest SEBI regulation, we can invest only in CD. Previously, CPs were also, commercial papers were also allowed. Now only CDs are allowed. So remaining amount is usually invested in CDs to take care of the liquidity portion. So this is the arbitrage statistics as on 30th May. You can see 67% is in arbitrage, remaining is in mutual fund units, cash, or CP and CDs. Next, we'll move to conservative hybrid and DAF, dynamic asset allocation. The conservative hybrid and DAF now, after SEBI allowed or SEBI classified REITs as equity, most of the portfolio, close to 95% of the 95% of the portfolio is same. Both schemes replicate each other in terms of asset allocation, in terms of holding. We've got this questions whether who should invest in DAP, who should invest in conservative hybrid. Both schemes are predominantly debt-oriented, debt-focused schemes. The only and the biggest difference in dynamic asset allocation and conservative hybrid is for dynamic asset allocation, the taxation after 2 years is equity taxation. For conservative hybrid, long-term taxation remains your marginal taxation. That's the biggest differentiating between both schemes. And we continue to run both schemes separately, and that difference remains as it is. So there are a few points. Who should invest, what are the components, and you can go through. So this is the comparison of both schemes. You will see both the schemes are more or less same, except for arbitrage allocation in dynamic asset allocation. We'll talk about that in next slide, asset allocation in the scheme, but you will see the tax long-term capital gain. In conservative hybrid, it is as per income slab, and in dynamic asset allocation, it is 12.5% after 2 years. So that's the change in both schemes, and one should take note of this. This is the asset allocation of both schemes. Dynamic asset allocation has close to 25% equity, out of which 15% as we speak is unhedged equity, 10% is REIT. REIT is now classified as equity, but we've given the separate line item just for understanding. Close to 12 to 13% in arbitrage and 62% is in debt. So about 35% above investment remain in equity and equity-related instruments in dynamic asset allocation, out of which 10% is arbitrage, 12% arbitrage, and remaining 25% is equity. In conservative hybrid, close to 10% is in equity, and REIT is close to 10%, and 78% is in debt. So this is the differentiating factor between both schemes in terms of asset allocation. Within asset class, this is how they are managed. Close to 45 to 50% is in sovereign in dynamic asset allocation. Conservative is close to 60%. Close to 10 to 15% is in corporate bond in both schemes. It keeps changing depending upon the opportunities we find, the spreads we find, that keeps changing between 10% to 25 or 15% in both schemes. But more or less, if you'll see in terms of debt, the average maturity of the schemes, both of them is close to similar. One is 4.5 years, the other is 4.8 years. YTM will also be more or less close, 5 to 10 basis here and there. So both schemes in terms of debt allocation are identical. This is one chart which we want you to focus on. This is the chart of dynamic asset allocation versus the category return. Idea behind this chart is not to tell you that we've outperformed since inception to the category. The idea of this chart is to tell you that the volatility in return in our dynamic asset allocation will be far less compared to the category, predominantly because our dynamic asset allocation scheme is run as a debt-focused scheme, and not we don't really change our asset allocation drastically to equity. even if the valuations are attractive. We've said it in our presentation that our equity exposure, unhedged equity exposure, will remain between 15 to 20%, and remaining portion, close to 65%, will remain in debt. Considering that in mind, the volatility in return versus the category will be far less. This chart, we don't want to tell you that we will continue to outperform the category, but just to put you in a head that this the volatility of the return will remain lower compared to the category schemes or the other schemes in that category. So this is what the basic structure of our schemes in terms of cash management as well as hybrid is there. I'll cover some the market outlook. We've got some queries about market outlook also from debt point of view. So we've globally we've had the Middle East crisis, oil touching 120 in recent times. Most of it is now behind us as we speak. Oil is close to $76-$75. The more than the oil prices, the constraint on supply, the actual supply which we are facing is now normalized. From debt point of view, I think the more concern was from the balance of payment BOP point of view, which RBI took care in the recent policy when they announced the FCNR scheme for non-resident, where they are allowed to invest in, the banks were allowed to increase their deposit rates, and the hedging cost will be taken care of by RBI. The expected inflow from that scheme is close to 50 billion. So most of the BOP issue was behind us, and that's where the market has started taking comfort in terms of positioning in debt. I think the panic which was there in debt market is behind us for time being. We continue to like 3 to 5 year segment of the on the curve. Our position remains in that segment. We've built our position during last 2-3 months to take advantage of that, and we continue to remain constructive in that particular segment. Beyond that, in terms of currency, I think with the BOP issue behind us, we should see currency fluctuating far lesser compared to what we've seen in last 2 months. Our expected range for currency is anywhere between 93 to 95 for next 3 to 6 months. I think that's it from our end. We can take the questions, and if there are any live questions, we can go ahead.
We will now proceed with a curated set of questions received through the registration form. Following this, we will take live questions. In the meantime, participants are requested to submit their live questions by clicking on the Q&A button in the Teams app.
Just the first question is a continuation on the market outlook. Given the current global and RBI monetary policy stance, how are you managing the portfolio duration and maturity profile to protect investor returns from interest rate volatility?
So we don't tend to take higher duration calls in our hybrid scheme. Our average or the range of maturity usually ranges from 4 year to 5 year. So in such volatile times, we don't really take our portfolio specifically does not impact a lot, doesn't get impacted a lot. Obviously, if there are opportunities, we tend to increase or go to the higher end of the band, which I mentioned, which we did in last 2-3 months. We moved from close to 4 maturity to 4.6, 4.7 in last 2 to 3 months. But in terms of volatility, we don't really go and invest in longer dated securities just to not have that shock in our portfolio. In terms of credit, as I said, we continue to invest in only AAA asset, long-term AAA asset. We have close to 33 companies universe under us, where Mansi takes care of the credit, and we continue to avoid taking any credit risk in our portfolio.
The next question is to Rukun regarding the arbitrage fund. With increase in STT, what is the tentative break-even period for investing in arbitrage fund as compared to a liquid fund? Before STT increase, I understood it would be around 3 months. Currently, what is the minimum investment period that is advisable to invest in an arbitrage fund?
So, first of all, I wouldn't call it break-even period because it inherently assumes that we know what kind of returns the arbitrage fund or liquid fund would have going forward, which we cannot. But when I talk about ideal investment horizon, we've said that 3 months is ideally the minimum horizon that an investor should have, and 6 months is more like the right horizon while investing in arbitrage funds. And this has been the case not because of transaction costs or STT or things like that, but this is more to do with the fact that arbitrage spreads tend to be volatile. So from one day to next, on an annualized basis, spreads can move anywhere from 50 bips to 100 bips just from one day to the next day. So and because of that volatility in spreads, there can be M2M impacts over a short period of time. So when an investor invests for, let's say, 3 to 6 months, that M2M impact gets evened out. So some days, the M2M is positive, some days it's negative, and over that 3 to 6 month kind of a time horizon, that gets evened out. So that still remains the case. Ideally, the investor should have something like a 6-month time horizon when they're investing in arbitrage funds.
The next question is to Tejas on return expectations from hybrid funds. Performance have been difficult to come by in the past few quarters. How much return expectation one should have in the hybrids for the next 2 to 3 years?
See, last 2-3 quarters we've seen, obviously because of the Middle East crisis, there has been volatility in the market. Usually what we've been suggesting our investor that you have to stay invested in our hybrids at least for 2.5 to 3 years, so that the assets which we manage or the instruments which we invest go through cycles in that 3-year period. We've seen 2 to 3 year returns in dynamic asset or any of the hybrids have been close to 7, depending upon your entry point. It's difficult to tell you the return expectations, what we expect in next 2 to 3 years, predominantly because of the volatility. But to put it mathematically, our current maturity profile of the scheme is close to 4-year, 3-year Macaulay duration. If you stay invested for 3 years, our current YTM is close to 7.3. 70% of the portfolio is invested into debt securities with 7.3% YTM. 10% is in arbitrage, which yields close to 6.5%, which was yielding close to 6.5%. Remaining 25% in equity. So if you do the math, you'll get to the number basically. But expectations, I don't want to put in a particular number into it, but considering the YTM and the arbitrage yields in recent past, but it keeps changing. Can't really comment on specific number.
The next question is to Rukun, comparing CHF and DAF. Why is there a gap of 5% of long equity allocation between DAF and CHF? Does it mean investors need to have different risk appetite for both these funds?
No, not really. So, first of all, there have been regulation changes around this. So earlier, for example, CHF was allowed to do REITs while DAF was not allowed to do REITs. And post the regulation changes, REITs are now considered equity. So both CHF and DAF are allowed to invest in REITs. So, which is where there has been some timing mismatch in, when the REITs were bought in DAF versus when they were bought in CHF. And that has caused some differential in the unhedged equity portion. But overall, the idea is to manage them in a very similar way. Obviously, CHF has the constraint that equity overall, which includes unhedged equity, REITs, and arbitrage, cannot be more than 25%. So consequently, while DAF does not have that restriction as a category. So let's say if in any given month or in a given period, if arbitrage is giving a very high return, let's say 8-9% or something like that, then in DAF, we can have a higher arbitrage allocation, while in CHF, we will be limited by that 25% limit. So to that extent, there might be some differences at the margin, but overall, I think both the funds are catered or are targeted towards investors with the same kind of a risk appetite, which is a conservative investor who wants more debt-focused hybrids. And there are differentiation in the taxes as well, wherein DEF will get benefit of equity taxation, while CHF won't have that.
Just a continuation of this to Tejas. From a debt point of view, is there a difference in risk profile for both of these funds?
No, I think I covered this question in presentation. Both schemes, we invest in similar papers, similar maturity and similar credit profile.
The next question is to Rukun on arbitrage funds. In arbitrage fund, could you elaborate on the expense ratio structure and the specific impact of the 0.25% exit load if redeemed within 30 days on the fund's overall portfolio returns, portfolio turnover?
So exit load as such, goes back to the scheme. So it does not benefit the AMC, but it is predominantly there because, as I said in one of the earlier questions, that because of M2M impacts and volatility in ARB spreads, we want that ideally an investor who's coming in has a 3 to 6 month kind of a time horizon. Coming to the expense or the TR part of it, there has been quite a lot of discussion on this, especially if you are looking at reported TERs. So the thing is, now brokerage and everything is disclosed separately versus what it was earlier, and this gets also annualized. So let's say if I'm doing a rollover on a given day, and hypothetically, let's say I do the rollover, the entire rollover of my equity arbitrage book on one day. So obviously on that day, the brokerage is going to be high, but it is not that I'm incurring that brokerage every day throughout the year. Yet on that day, because that brokerage gets annualized, you might see a very high TER for that particular day, simply because of the way this is getting reported. So if you see the base management fee and things like that, there hasn't been any volatility around that. The only volatility you see is on things like STT, brokerage and other transaction costs, which is essentially because these are getting annualized. So I would say don't read too much into that. I think the industry as a whole is trying to figure out how to best disclose this. So as and when something on that comes around, probably the disclosures will improve. But other than that, there hasn't been any major change in the way we charge the base management fee or things like that. It is just the disclosures that have changed.
The next question is to Tejas on DAF returns. How do you justify DAF's last 1 year return at 2.8%? It has not generated savings bank interest rate.
So, as I've answered in the previous question, that if you are investing in hybrids, you have to look at 2.5 or 3 years return. Anything lesser than that, market goes through intermittent volatility. It's very difficult to justify or tell you point-to-point returns. If you take 2.5 or the DAP return from inception, which was February 24, we are close to 2.5 years into the scheme, and the product is delivering what it is supposed to. The return is close to 7 quarters, 7.5. And I think 1 year is not the right time horizon for you to look at returns. One has to stay invested for 3 years for that particular scheme to go through cycles to accrue in underlying investments. So I would say one should look at 2.5, 3 year return profile of the scheme rather than 6 months, quarterly or annual return.
So just to elaborate on what Tejas is saying, see on debt, if yields go up, you have an M2M impact, but your holding period doesn't necessarily change, or holding period return doesn't necessarily change. So if yields go up in the interim, you might see that returns are lower. In the last 1 year, equities have not been great in terms of performance, so that has at the margin had some impact. But the other way to look at it is that from a prospective basis, the YTMs on the debt portion are better. The equities that we were holding, the dividend yields on them have gone up because the underlying equity prices have corrected. So on a prospective basis, debt have YTMs higher, dividend yields higher. In many cases, the REIT yields are also better than what they were last year. So, 1 year you might make a less return, which might get offset by, the subsequent 2-3 years. So, which is where having that 3-year time horizon is important.
The next question is to Tejas on the CHF fund. Can we assume that the bonds being held in our CHF fund will be held till their respective maturity periods so that the temporary fall in bond prices will be set off eventually?
So we hold till maturity would not be a right strategy. What we try to do is we don't trade a lot in these schemes. What we would do is we would have staggered maturities, say 1 year, 2 year, 4 year, 5 year in securities. If we find an opportunity, say I have a 3-year bond which I roll down to say 1 year. Now the 1 year paper versus say 3-year, 4-year paper during that time, if I'm getting attractive spreads, if our internal call is that 3-year, 4-year maturity is far better than holding into 1 year, then we will switch into 3 to 4 year securities. We tend to keep churning our portfolio and keep maintaining that 4 to 5 year of maturity. But yes, we don't take extreme calls of going on cash. We don't churn a lot in terms of our debt securities. We roll it down as much as possible, but as and when we see an opportunity in asset classes, may that be state development loans, government bonds, or corporate bonds, we tend to rebalance our portfolio as and when required.
The next question is to Mansi. For DAF and CHF schemes, what is the team's approach on duration and credit quality of the debt portion?
For both the schemes, we have adopted a laddered approach, which will help us to balance interest rate risk, liquidity, and return across market cycles. We don't take any interest rate calls. We have spread our investment across maturities, and we avoid taking any concentrated duration bet. Both the portfolios, CHF and DAF, is a blend of high quality AAA corporate papers, which are short to medium term, and medium term SDLs. And we have been maintaining, like Tejas said, maturity of between 4 to 5 years and duration of 3 to 4 years. So regarding the duration, we aim to make the portfolio stable, having stable returns. And for regarding credit, we will continue to invest in state development loans, GSEC and AAA papers, and we will not go beyond that and taking and lower rated papers.
As a reminder to all participants, you may submit your questions by clicking on the Q&A button in your Teams app.
The next question is to Tejas, more of a personal finance question. In falling markets, is it advisable to average out mutual fund holdings, buying more in the existing flexi cap funds, or hold cash in the liquid funds?
So if your asset allocation allows you to buy more of equity, then obviously something which you like at say 100 rupees, you should buy at 90 rupees also. But strictly, one should look at the asset allocation of individual portfolio, the investment horizon of what your investments, and whether you're comfortable holding on to that equity allocation for next 5 years, then one should of course look at adding at lower levels. If your investment horizon for that particular amount is not more than 5 year. If you're looking at short-term parking tool, then one should look at one should park money into liquid fund or arbitrage, and not try to buy additional flexi cap. But as I said, asset allocation and investment horizon permits, and one should look at adding at lower levels also.
The next question is to Rukun on equity in the DAF fund. To maintain the long-term capital gain advantage, you keep the minimum equity allocation at around 35%. In a highly overvalued market scenario where you might want to reduce the equity completely, how do you balance this tax requirement?
So the 35% equity that we maintain includes unhedged equity, it includes arbitrage, and it also includes REITs. So if you look at only the unhedged equity portion, that has been maintained between 15 to 20%. Typically, even in a bad market scenario, you are able to find equities that are undervalued and that are yielding or that are giving good dividend yields. So as has been the case in the last 1-2 years. So we do not expect that the unhedged equity will go to zero, but we can have it at, let's say, the lower end of that range of something like 15%, and the rest is then filled up by arbitrage and REITs, depending on the yields that we are getting in REITs and the spreads that we are getting in arbitrage.
The next question is to Mansi on liquid fund. How do you balance the liquid fund between yield enhancement, capital preservation, and liquidity? How do you decide between various short-term instruments like T-bills, treasury repos, CDs, CPs, and short-term corporate bonds?
For regulation, we need to invest minimum 20% in treasury bills, TREPs, and repo. So that is a minimum requirement which take care of the capital preservation and the liquidity. Beyond that, we invest 40 to 45% in highly liquid private and PSU banks AAA CDs, which are widely accepted by banks and corporates. So whenever we want to liquidate, plus we are getting a yield better than treasury bills and repo. Rest of the portfolio, we selectively add high quality AAA CPs whenever they are available at attractive yields. And also we look for the liquidity of the particular security. We invest in a variety of securities so that the single issuer, we will not concentrate our portfolio on a single issuer, and we are comfortable with the liquidity for the securities and also the yields we are getting and the credit quality.
Just a continuation of this question. How well is the fund prepared to protect small investors if there are large redemptions from institutional investors?
Yeah, we invest in, since I've told you that we invest in high quality AAA CDs and CPs, which are widely accepted by and which are very liquid and as based on the traded volume, and which are widely accepted by banks, corporates, and other mutual funds. So we are very much comfortable with the credit and the liquidity of our papers which we purchase in our scheme.
The next question is to Tejas. Your conservative height. Sorry, go ahead.
To add Mansi's point, regulatory wise, as rightly she said, we have to invest 20% in LRAR securities, which are treasury bills, cash, and TREPs. We have to maintain CRAR also, which is over and above LRAR requirements. So most of the liquidity requirements or the redemption requirements are taken care through these securities. These are regulatory requirements prescribed by SEBI. So even if there are large redemptions, this 20-25% of the portfolio takes care of those schemes, and top of that, we invest only in AAA liquid CDs. So we've never had any such liquidity issues per se in past. Yeah, Prithvi.
Yeah. The next question is to Tejas. Your conservative hybrid is doing well. When does the company come out with an aggressive hybrid fund?
Honestly, we don't have any such plans in near terms. We continue to run these 3 buckets in schemes right now. But of course, as and when we have something in our mind, we will inform you about that. But right now, we don't have such plans.
The next question is to Rukun. Commodities like gold and silver outperform during uncertain times, including wars, which is very evident from recent times also. An obvious question rises that why you did not launch any gold silver based fund. Moreover, you even do not have a multi-asset allocation fund. Any specific reason for not having such funds until now?
So when we talk about gold and silver, these are commodities or these are precious metals that do not generate any cash flows. So unlike a equity stock, which you can probably value for its cash flows, or a bond, which you can value based on the cash flows you are going to get, in case of these precious metals, the value or the way they are valued is what somebody else is willing to pay you. So the value of gold is today what anybody else would pay you for that gold in the market. In which case we do not feel that there is any major value addition that we would be able to do in these commodities at our end. So there are a lot of gold and silver index funds and ETFs that are listed, and to the extent that an investor does want to have some allocation to it, they can, from their portfolio perspective, they can add the other funds that are there in the market. At our end, we felt that we will not be able to provide any major value addition to that space, and which is where we've stayed away so far.
As a reminder to all participants, you may submit your questions by clicking on the Q&A button in your Teams app.
We'll take some live questions now. First question is to Tejas or Mansi. Do you invest in A1 plus rated short-term instruments where the long-term rating of the company is less than AAA?
No, we don't. So most of the securities are A1 rated short-term. What we look at is we look at long-term AAA rated securities only. We have a process of approving even in AAA, we have a process of approving a company where Mansi, who looks after credit, takes care of the credit profile first, then it goes to investment committee, then it goes to credit committee, then the approval comes from both committees, and then we invest. But for that, the company has to be long-term AAA rated. The first comfort has to be the credit analyst, second to investment committee, then the credit committee. Till then, we don't invest in any such papers.
The next question is to Rukun. REIT prices have corrected by nearly 10% since February 2026. What is your current view on Indian REITs from both capital appreciation and distribution yield perspective, and why Mindspace REIT is not part of DAAF portfolio?
So overall, we've liked the REIT space. We typically the REITs that we've owned have yielded anywhere between, let's say, 5.5 to 6.5, 7%. And there have been annual rental escalations as well. So from a long-term growth perspective, the yield plus the annual escalations is the return that you end up making. While constructing the portfolio, what we've tried to do is have exposure to multiple yields, multiple REITs, wherein the selection criteria is one, based on what is the yield that we are getting, and second, are we able to diversify the geographic exposure from a portfolio perspective? So ideally, you don't want that the entire portfolio or all the REITs are focused on one particular geography and things like that. Specifically talking about DAAF and why the difference versus CHF in terms of the portfolio. As I highlighted earlier, in DAAF, REITs were allowed or have been allowed only in the recent times. So earlier, DAAF was not allowed to invest in REITs. Now, ever since that regulation change allowed us to invest in REITs, we've invested wherever the yields were favorable. So, if in a particular name the yields were lower, we've not added to that to the portfolio yet. If things change in the future, it can, we might relook at the other names as well.
The next question is to Tejas. Due to soaring inflation, RBI may have room to raise rates. Keeping in mind the rate hikes, what will be the impact on debt side, specific medium-term opportunities and GSEC funds?
So, first thing, honestly, we are not expecting rate hikes in near term, predominantly because RBI looks at 1 year down the line inflation expectations, and most of it should be demand side driven if RBI has to move in near term. I think the recent higher inflation expectations have predominantly from supply side disruption, where RBI or government does not really have a lot of control on it. On top of that, central government has managed to absorb most of the price hikes in crude through AMCs or on their own balance sheet. So the retail have not really taken a big hit of supply side disruption. As I said in my opening remarks, your crude is now back to its normal levels of 75, 76. I think RBI will look at this situation as a one-off situation, or probably see how things pan out in next 3 to 4 quarters before moving on, or rather acting on the rates front. Obviously the El Nino impact remains unanswered or uncertain, and the impact of that on inflation is something which we are watching carefully. But if monsoons are close to normal against the predictions, then I don't think so RBI will really need to move rates anytime soon. Of course, inflation, if RBI is in RBI's say band of 4% plus and minus 2%, then RBI will probably wait and watch and let go of this event as one-off situation. Having said that, if RBI is to move, or if interest rates, operating rates are to go higher, market was prepared for this scenario, and predominantly because of that reason, you saw yields on across curve, yields moved close to 60 to 70 basis higher, with expectations that RBI will probably hikes rates sooner than later. Now, a lot of expectations have normalized. A lot of market instruments have come off from their recent highs in terms of yields. The immediate impact of this, I don't think so, will be drastic. Probably a couple of basis here and there. But I'm not really seeing a lot of volatility and any near-time action from RBI in terms of operating rate.
Yeah. The next question is to Rukun. What is observed is that the equity holdings in hybrid schemes are mostly high dividend-paying companies. Will the fund management team look at undervalued banking companies which may not have high dividend yields?
So far the strategy is that try and identify companies wherein there is a high cash yield or a high cash return that is possible. So whether it's through dividends or buybacks, and that continues to be the strategy. So because the product is aimed at investors who have 3-year kind of a time horizon, and who over that period who are let's say on the risk return spectrum, they're more towards the conservative side. We prefer having equities wherein there is there is support from the dividend yield or buyback yield, and so on. So that continues to remain that strategy.
The next question is to Tejas. You covered most of it already. How much impact on bond prices in portfolio by changing RBI rates by 0.25 to 0.5%?
So there is something we track OIS, overnight index swap, where market tend to price in RBI's future actions through derivatives. Right now, it is already pricing in close to 50 basis of rate hike. So which indicates that even if RBI hikes in next say two policies by 50 basis, that impact already is there in the current bond yields. So I don't think so there will be a drastic change in yields. Of course, because of uncertainty, the volatility may be there of 10 to 15 basis, but I'm not really expecting a drastic change in yields compared to change in operating rate by RBI.
The next question is to Rukun. Your equity allocation is among the lowest in industry. What are the triggers you are looking to increase the equity allocation? I think this is for the DAF fund. Further, if you can elaborate on how exactly net equity position is decided, that would help.
Yeah, so as I said, I think Tejas also highlighted this in his presentation. In the industry, most of the DAF funds or the balanced advantage funds, they are essentially targeted towards the aggressive hybrid or an investor who wants a aggressive or a higher equity allocation. Ours is one of the few funds which is targeted towards a conservative investor, an investor who wants a higher debt allocation. So consequently, our unhedged equity book will remain within that 15 to 20% kind of a range. If things are very attractive, we might be towards the higher end of the range, and if things are not that great, we'll be towards the lower end of that range. But the idea is not to vary it a lot based on equity market cycles. It remains a product that is focused towards having a higher debt allocation, which includes, let's say, debt, arbitrage, and REITs.
As a reminder to all participants, you may submit your questions by clicking on the Q&A button in your Teams app.
The next question is again to Rukun. We have around 10% investment in REITs in both CHF and DAF, but we have few established InvITs also, which have more than 4 to 5 years of distribution history. Why we didn't invest in InvITs in both of these funds?
So, unlike REITs, InvITs need much higher assumptions in terms of pricing them. So, in case of REITs, first of all, the commercial real estate market overall has been fairly strong. Most of the REITs that we own are operating at very high occupancy levels. Incrementally, in addition to the yield, typically we've seen that rental escalations tend to follow the inflation. So in REITs, the risk return or the risk in assumptions is fairly less, versus when we talk about InvITs, if it's a road InvIT, one needs to price in things like what would happen to traffic if an alternative road comes up. If it is a telecom InvIT or rather a grid InvIT, one needs to think through as to what will happen once the concession period ends, and is there a terminal value to that asset or not. So because of all those assumptions, and wherein things can go either in your favor or against your favor, when it comes to InvITs, we've been more in the wait and watch kind of a mode. This is not to say that we will not have InvITs in the future at any point of time. If we do come across InvITs wherein even with conservative assumptions, we believe that the risk return is favorable, we would add them. But so far, we found that REITs have been a much better area to deploy the portfolio in.
How much dividend yield return expectation should we have from the IDCW plans of CHF and DAF funds for income generation?
So we cannot, talk about prospective returns, and essentially dividend yield would be the same as talking about prospective returns. They just did give a framework as to how one can think about the returns from these products, which is, you can see where the YTMs are for the debt portion. Arbitrage, as he said, has so far yielded somewhere between 6 to 7%. Obviously, that keeps changing as we go forward, depending on arbitrage spreads. REIT yields are out in the, are publicly available. So one can mathematically, try and work out what the numbers would look like. Having said that, the one piece that is the most volatile is the unhedged equity portion, which in both schemes is is relatively less. So one can work out the numbers and take and make an educated guess, but we can't really give a number out there.
As a reminder to all participants, you may submit your questions by clicking on the Q&A button in your Teams app. We will pause briefly to allow any additional questions to be submitted.
Just while we wait for the questions, I will just add one caveat to the previous answer. The dividend in the IDCW plan can be given only from realized profits. So while when it comes to bonds and the debt portion, the realized profits or the realized capital return is relatively straightforward. In case of equities, it may not be straightforward. So let's say if we hold a share for 100 rupees and a year later it goes up to 120, but we do not sell it, then as such, there is no realized gain. And to that extent, the dividends will not exactly match with your 1 year return or whatever that period return is. So that's just one caveat to keep in mind.
So usually adding to what Rukun is saying, we've been saying that SWP is something which you can explore. So what we've been informing our investor, you stay invested for 2 years, certain amount of interest income, certain amount of dividend income is accumulated in your portfolio. And then SWP is the plan which you can exercise, which will give you stated your expected 2 to 3% of capital withdrawal from the scheme investments. So the dividend option will, as Rukun rightly said, depends on how much profit we are booking, how much dividend income we are generating. So it keeps changing and becomes volatile and slightly unpredictable compared to SWP option. That's one option one can look at from operational angle of your investments.
Since no further questions have been received, we will conclude the call at this time. Thank you to all our partners for taking the time to participate in this call. Thank you, Tejas and the investment team. The recording of this call as well as the equity call will be available soon on our website. You may now disconnect from the call.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.